Welcome to The Explainer. Today we're tackling something that's super important, but let's be honest, can be really confusing: life insurance. We're going to cut right through all the jargon and get straight to what you actually need to know. All right, let's kick things off with a question you already get, because the logic here is exactly the same for life insurance. Think about where you live. Are you renting, just for a set amount of time, or are you owning it, building it as a long-term asset? Just hang on to that thought. It's the key to literally everything we're about to talk about. So, at its core, all life insurance has one main job, right? It's there to provide a tax-free payout, a death benefit, to protect the people you care about financially if something happens to you. It's that critical safety net. But right from that starting point, the path splits. And listen, this is probably the single biggest decision you're going to make when you pick a policy. And yeah, it all comes right back to that idea of renting versus owning. So, what are you looking for? Pure, simple protection for a limited time? Or do you want to own a financial asset that's going to last your entire life? Okay, let's break this down. On one side, you've got term life. This is exactly like renting your protection. It's super straightforward, usually way cheaper, and it covers you for a specific period, like say 20 years while the kids are growing up and you're paying off the house. Simple. Then, on the other side, you have cash value policies. Now, this is like owning your protection. Sure, it costs more, but it's designed to cover you for life. And here's the kicker: it actually builds a cash asset that you can use. So how does this owning thing actually work? I mean, for a lot of people, this is where it gets kind of murky, like a total black box. So let's crack that thing open and really see what's going on inside a cash value policy. Okay, here's the most important thing to get. Your premium, the money you pay, is actually doing two different jobs at the exact same time. It's not just paying for that protection. Nope, it's also building wealth for you. First up, you've got the death benefit. That's the core promise, right? The money your family gets income tax free. But then you've got the second piece, the cash value. Think of it like a separate bucket of money inside the policy that grows, tax deferred, and turns into a real financial asset, an asset for you that you can tap into while you're still around. Okay, now this is where things get really interesting, because you can actually tailor a policy to fit your own financial style. It's kind of like a spectrum of risk and reward. All the way on the safest end, you've got whole life. The premiums are fixed, the growth is predictable, it's the bedrock, totally solid. Then you can move into some more flexible options, like universal and indexed universal. Here the growth is tied to things like interest rates or even stock market indexes, so you get more potential upside, but, a little less certainty. And then, for anyone who's really comfortable with more risk, there's variable life. With this one, you're pretty much investing that cash value right in the market, shooting for the highest growth, but you're also taking on the highest risk. Makes sense, right? So you've been paying into this thing, building up this cash value, but it's not just some number on a piece of paper. It's a real financial asset. So the big question is, how do you actually get your hands on that money? Well, you've got a few ways to do it. You can just make a withdrawal. You could use that cash to pay for the policy itself, pay the premiums. Or you could even just surrender the whole thing and take the cash. But honestly, one of the most powerful and common ways people use it is by taking out a policy loan. And this right here is where that owning part really starts to shine. You can borrow against your own cash value and get this: no credit check needed. It doesn't even show up on your credit report. And the repayment? Totally flexible on your own schedule. I mean, that's a level of private, easy access financing that you're just not going to get from a bank. No way. But, and this is a huge but, there's a major catch. Any loan you don't pay back, it gets taken straight out of the death benefit. So just look at this example. That loan takes a big bite out of what your family ultimately receives. It's an incredibly powerful tool, for sure, but you got to remember it has a direct impact on the legacy you're trying to leave behind. Which brings us to probably the most important reality check of all: the cost and the trade-offs. Because all those cool features we just talked about in a cash value policy, well, they definitely come at a price. Let's just look at the numbers, because they really tell the story. A healthy 40-year-old guy could probably get a $250,000 term policy for, maybe $20 a month. Now compare that to a permanent final expense policy, which is basically a small whole life policy. A 65-year-old woman might pay over $42 a month for just a $10,000 benefit. The difference in price for just pure protection is, it's massive. So you might be asking, why on earth would anyone pay that much more? Well, it's because you're not just buying a death benefit. You're buying lifelong coverage that can never expire. You're buying a tax advantage savings tool. And you're buying a super flexible source of cash that you can use for emergencies, opportunities, or even to help out in retirement. Okay, but what if the insurance company itself fails? That's a totally fair question, right? I mean, you're paying into this thing for decades. You have to know your money is safe. And the good news is, there actually is a safety net already in place for that exact scenario. It's called the State Insurance Guarantee Association. And here's the deal. Every single licensed insurance company is required by law to be a member. So if one company goes under, these state-level groups step in. They basically get the money from all the other healthy insurance companies to make sure you, the policyholder, are protected. And we're not talking about small potatoes here. This protection is substantial. Now, it does vary a little from state to state, but most of them will cover up to $300,000 in death benefits and $100,000 in cash value for each person. So that means even in a total worst-case scenario, your policy is still protected up to some really significant limits. All right, so after going through all of that, how in the world do you decide which path is the right one for you? Are you renting protection with a term policy, or are you owning it with cash value? At the end of the day, it really just boils down to a trade-off. On the one hand, cash value gives you these powerful, lifelong financial perks, but on the other hand, it costs a lot more, is way more complex, and yeah, you run the risk of shrinking your death benefit if you actually use that cash. And this quote here from AAA, it just sums up the case for term insurance perfectly. Honestly, for a lot of people, this is the most logical choice. If your main goal is temporary, covering the mortgage until it's paid off, making sure the kids are covered until they're on their own, then that simple, much more affordable renting model is probably exactly what you're looking for. So look, the right choice really isn't about which policy is better in a vacuum. It's not. It's all about figuring out what specific financial job you need your life insurance to do. Is the job to get the most protection for the lowest possible cost just for a set number of years? Or is the job to create a lifelong safety net that also happens to be a financial asset? If you can answer that one question, that is the key to finding the absolute right policy for you.